But the banks don't like financing the used assets as much. It's not that they won't do it, it's just more difficult.
I can see the whole wide world with these two eyes, and I can be whoever I wanna be, 'cause it's my life.
Hi, thanks for joining us for another episode of Ask Spurl CPA. Today, as the Edmonton Business Coach, we're talking about business plan financing required. So getting financing with your business plan. I have Laura here with me again. Laura, any big plans for the summer?
Just enjoy the sunshine when it comes.
If it stops raining, we had a little reprieve, and then it's back to some rain. Yeah, I'm hoping we get to enjoy some sunshine too. So the quote that we have here today, Robert Kiyosaki quote, author of Rich Dad Poor Dad, and he says, "Good debt is a powerful tool, but bad debt can kill you." Now, Industry Canada tells us that 51% of small businesses will seek external financing. And of course, we know that 29% of failed businesses list running out of cash as one of the primary reasons for failure, making running out of cash the second most common reason for business failure. And the circumstance, the story that we run into are most business owners, they're not specific enough about the financing they require in the business plan. Thus, they end up getting rejected altogether because the bank doesn't quite understand what they want, or they end up with a loan that they're not going to be able to make the payments on. So, Laura, what are the questions that these business owners should be asking so they get it right in the business plan when they're asking for financing?
Do you recommend putting the financing required in the executive summary?
Yeah, first thing, a lot of times people want financing and you look through the whole business plan and maybe it's not even there or it's buried. Put it right at the top. This is like one of the most important things about the plan. You want to put it right in the executive summary. Exactly what financing that you want, put it right at the beginning. Don't leave it to chance that they see it or not.
What's the difference between a term loan and a mortgage?
So a term loan and a mortgage, generally, they have specific principal and interest payments. They both have specific set principal and interest payments. It might vary based on a floating rate around prime, or it might be a fixed rate. But 9 times out of 10, a mortgage relates to real property. So it breaks to real estate. So one's on, think of it's a building or a house or land. The mortgage is on real estate, and the term loan is generally on equipment or a build out. Sometimes it can be an unsecured term loan, just more of like a debt consolidation thing. And it's a specific termed out loan. So when you think about if it's mortgage or term loan, functionally they're the same. They have interest and principal component to the set repayment schedule, but mortgages are based on real estate.
Should you be specific about the purchase price of assets you're trying to finance?
Yeah, so sometimes the mistake is you ask for a set amount of financing and say that you want to buy that new welding truck, and that new welding truck is $100,000 all decked out, and you're asking the bank for $50,000. And the bank might consider that, okay, you want 100% of that new asset, and they're going to reject you because you just asked for $50,000. But if you told them you only want 50 of the $100,000 asset and you're putting another 50 of your own money into the deal, now all of a sudden the discussion changes. Now they think that this is a much more secure risk. So you shouldn't just ask for the amount. You should be specific about the cost and the use of that money, where it's going to go, because it'll change the bank's answer sometimes.
Is it more difficult to get financing for assets previously purchased?
Yeah, here can be, the problem is you have just enough cash to go out and do the deal yourself. You can build out the office, you can buy a bunch of major equipment, and you got enough cash in the bank or maybe room on the credit line, and they go out and they spend right to that limit. And then they think, if it goes close, I'll try to refinance it after. But the banks don't like financing the used assets as much. It's not that they won't do it, it's just more difficult. Often you could have gotten approved if you had done it a year before when that, equipment was new. The bank is more aggressive on lending to new equipment or even used equipment when it's initially purchased. But, once you go to the bank with your hand out and you say, can you lend based on this thing that I bought last year? now the whole tone of the conversation changes. So you got to be very careful that when you buy that equipment, you say, is this the time to get financing in place? Because we might not get another crack at it down the road if we're short on cash.
How is the amortization period different than the maturity date?
So people think sometimes maturity date, but you got to think amortization period. So maturity date is when the loan is going to come up for renew. The terms of the loan might change. The interest rate might change. The bank could call the loan. That could happen. Not the usual course of action if you're maintaining their covenants, but could happen. But the amortization period is how long you're going to get to pay back the loan altogether. So the loan might be up for renew in 5 years, but you might have 20 years. The principal repayment amounts might be based on paying this thing back in 20 years. So it's extremely important to know when's that, maturity date. So when is the loan up for renewal, or renewal date or maturity date for the loan, versus when is the repayment period or amortization period of how long, the bank is considering that it's going to take you to pay back this loan.
Should you ask for a specific interest rate on an amortization period?
Yeah, so I mean, you should ask for a specific interest rate, but you should also ask for a specific amortization period. So don't leave that to chance. A lot of people are just like, I want a loan. But what if that loan is at 25%? I want $100,000, but what if the bank only gives you 5 years to pay it back, and you don't have enough time to pay it back? So be really specific on that, executive summary, the financing required. Put exactly how much you want, what you're going to use it for, how much that's going to cost, and you want to put on there, what interest rate you're expecting and what amortization period or repayment period you're expecting.
Is the interest rate of amortization period generally more important?
Generally, a lot of people think loans and they think interest rate. They think the best interest rate. If I get prime, that's better than prime plus a half. But what if your prime plus a half gives you 20 years to pay it back, and your prime gives you 5 years to pay it back? Scenario number one has lower interest rate, but you could run out of cash in the entire business just because you're trying to save a couple of bucks in interest. I would, suggest that more often than not, the amortization period is more important, especially if the interest rates are relatively close. We're talking one is 5% and the other one is 25%. We're talking, one is 5% and the other one is 6%. A lot of times the amortization period is more significant, in terms of the decision-making process than the interest rate.
How do lines of credit differ from term loans and mortgages?
So the majority of the time, the lines of credit that you get, you're not required to pay back any of the principal at a set intervals. You're just required to pay the interest as it's charged. And sometimes even the interest can be charged to the line of credit. So it provides that ultimate flexibility on when you're going to pay back.
Why are lines of credit normally better for cash flow?
So they, when you think about it, you got that term loan, and the term loan locks you into it. You got to pay $3,000 a month, whether you have the cash or not, principal and interest. But what if the interest on that is only $500? And you're short on cash, you start to get short on cash, now you can just pay that interest, and that $2,500, you can still use it for operations. So normally lines of credit are better for cash flow.
Are lines of credit harder to get?
They are harder to get, so the bank views them as there's a little less certainty in what's going on there, because they're giving, leaving it to your discretion on when you're going to pay back that amount. So they, the threshold to get that line of credit, although that might be the preferable solution, might not be available. They are harder to get.
Should amounts requested for each type of credit facility be specific?
Yeah, be really specific. I want this much for my term loan that's going to be used for this equipment that costs this much, and I want this interest rate over this amortization period, and I want this much for the mortgage. And again, really specific, used for a purchase of property that costs this amount, and I want this interest rate and this amortization period, and the same thing, I want this amount as a line of credit. Be very specific on which category that you want, because the bank can't normally guess what you want, and they'll normally revert to just giving like a term loan paid back under the least favorable terms, the shortest payment period possible. So you got to be really specific about what type of credit facility you want, what interest rate you want, what it's going to be used for, how much that costs, and what repayment, repayment terms or amortization terms that you're hoping for.
When applying for credit cards, should you be specific about who gets what limit?
Yeah, so just avoid the back and forth discussion, because as soon as you ask for a credit card, don't just ask for a credit card. You got to say, I want a credit card with a $20,000 limit, and $10,000 limit is going to be used for me as a business owner. Another $5,000 is going to be used for one of my managers. Another $5,000 is going to be used for this administrator. And I even put their names on the application. I tell the business owner, you put your name on it. This is the limit that you want on your card, and this is the limit you want for your manager, whose name is this, and your administrator's name is it. You're going to save yourself a whole bunch of back and forth communication. They're going to ask you those questions, before they even determine if you're going to qualify for that or not.
How will credit cards affect other financing requests?
So, often people think that the credit cards are separate from the other financing, but a lot of times the bank is not going to give you a credit card facility unless they have what they call first charge on your corporation. So in other words, the person who makes the big loan are the ones who want first charge on it. So if you give, the person who gives the big loan first charge on your corporation, but you don't have the credit cards worked out, now all of a sudden you're trying to use personal credit cards because you can't, qualify through that bank. So you want to ask for them at the same time. You want to be really clear about what credit card facilities you have. So sometimes it's a matter of, in that financing required section, a lot of times I'll list both the loans that we want and the loans that we already have in place, including credit card facilities that we already have in place, because you want them all approved at once. You want the person, the bank who's approving this thing to approve not just the term loans and the mortgages and the operating lines of credit, but also to have an amount set aside to give you as a credit card facility, so it all fits together and you have all of the various mechanisms of credit to use at your disposal. So I think that's what we have here today. As always, please hit that like and subscribe button so we can continue to deliver you tips on how to beat the odds at business. And as always, please leave us some comments below so we can respond back and use your input for future videos. Thanks very much.